Cipher Mining stock finished Friday on a high note. After weeks of volatility and speculation, CIFR closed at $14.70 per share, up 89 cents or just over 6.5% for the day. This move has caught the attention of traders and long-term investors alike because it looks like the stock is clawing its way back from the post-Google announcement slump and reclaiming momentum. Today we're going to walk through what happened, why the stock is rallying, and why this story is still one of the most interesting hybrid plays in the market. Last week's tape told a different story. Cipher had announced its landmark 10-year, $3 billion high-performance computing hosting agreement with Fluidstack, backed by Google, only to see the stock tumble. The deal included Google backstopping $1.4 billion of Fluidstack's lease obligations at the Black Pearl facility in Texas and receiving warrants for roughly 5.4% of Cipher's equity. It was the kind of partnership that many had been hoping for, a marquee technology giant validating Cipher's pivot from pure Bitcoin mining into artificial intelligence infrastructure. But instead of a rally to new highs, the stock plunged 17% on Thursday and another 1.5% on Friday. That was classic sell the news behavior as traders took profits, short interest increased, and fear of dilution dominated the conversation. Fast forward to this week and the picture is shifting. After a strong Monday rebound and some midweek consolidation, Friday's rally to 1470 looks like a statement by the market. There was no bombshell press release today, no sudden change in fundamentals, yet buyers stepped in and pushed the stock up more than 6%. That tells us sentiment is stabilizing and confidence is creeping back in. One driver of this move is simply the power of the underlying narrative. Cipher is not just a miner anymore. It is positioning itself as a hybrid infrastructure provider at the crossroads of crypto and AI. The Google and Fluidstack deal is the clearest sign of that. It is a decade-long agreement to host high-performance computing at Cipher's facilities, backed by Google's balance sheet. Google's warrants tie its upside to Cipher's execution. This is not a passive customer relationship. It's a strategic partnership that could reshape the company's future. That story did not disappear because the stock sold off. In fact, the pullback may have made it more attractive. After an overshoot to the upside and a violent correction, CIFR became technically oversold. Traders looking for a dip to buy got their chance. When they stepped in, the powerful underlying narrative gave them a reason to hold rather than just flip the trade. That's a classic setup for a rebound. Another ingredient is technical and sentiment dynamics. After weeks of volatility, short interest in Cipher has been elevated. JP Morgan even flagged it as one of three names with the ingredients for a potential short squeeze, citing high retail flows and significant short positioning. When a stock like this rebounds, shorts can be forced to cover, which adds fuel to the rally. Add momentum traders who chase strength and the move accelerates. We have also seen a subtle shift in how investors view the warrant and convertible note structure. Last week many were disappointed to learn that Google's stake came via warrants rather than an immediate equity injection. Warrants mean future dilution when exercised. The $1.1 billion in zero-coupon convertible notes also means future share issuance. For investors who hoped for a clean, cash upfront deal, that was a letdown. But as the dust settles, a different picture emerges. Google's upside is tied to Cipher's success. It only benefits if the stock price rises. That is exactly the kind of partner you want when building something ambitious. And the convertibles provide the capital to execute. Dilution will happen, but alongside growth in revenue and profitability. As that understanding spreads, the fear premium recedes and the stock can move on. The fundamentals continue to provide a floor. Cipher's August operational update showed 241 Bitcoin mined, 42 sold, and 1,414 Bitcoin held in treasury. Hash rate and efficiency at Black Pearl are exceeding prior guidance. Even before the AI hosting pivot, Cipher was executing well on its core mining business. That gives investors confidence that management can handle the new challenge. Macro conditions are also supportive. Bitcoin remains stable near $115,000. That bolsters miners' profitability. The Federal Reserve's rate cuts reduce financing costs for capital-intensive companies like Cipher. Lower rates also support risk assets broadly, which helps high beta names rebound from sell-offs. Combined, oversold technicals, a still powerful narrative, potential short covering, solid fundamentals, and a supportive macro backdrop, you have the recipe for Friday's 6.4% rally. It's important to keep perspective. One strong day does not erase last week's volatility. The stock is still below its recent highs. Dilution and execution risk remain real. The AI hosting build-out is ambitious. Power and latency constraints, customer onboarding, and cost control will all be challenges. But for investors who believe in the long-term thesis, this may be the kind of pullback and base building period that sets up the next leg higher. In the bullish scenario, the stock consolidates in the $12 to $15 zone, digests dilution fears, and then begins to move higher as more details of the Google deal are disclosed and initial AI hosting milestones are reported. As it proves execution and perhaps signs additional hyperscale customers, the market begins to value Cipher more like an infrastructure company than a miner, awarding it a higher multiple. In that case, last week's pullback is just a hiccup on the way to much higher levels. In the bearish scenario, execution stumbles. The AI hosting build-out is delayed or runs over budget. Bitcoin turns down sharply. Dilution weighs more than expected. In that case, the stock could revisit lower support levels or languish in a range. Even here, the Google partnership provides some downside protection, not in the stock price but in the credibility and long-term opportunity it represents. Another way to frame it is through time horizon. For traders, CIFR is going to be volatile. The swings can be used but require tight risk management. For investors, the key is whether Cipher can execute on this hybrid model and whether one is comfortable with dilution and the bumpy road to get there. Google's involvement does not guarantee smooth sailing but dramatically increases the odds that Cipher becomes more than just another miner. Technically, the levels to watch are support around $12 to $13 and resistance near $14 to $15. A sustained move above 15 would suggest the market is regaining confidence. A break back below 12 would signal that sellers remain in control. Volume will also be important. Strong up days on high volume are bullish. Weak bounces on light volume are less convincing. Friday's rally is a reminder that narratives this powerful do not die overnight. The Google partnership remains a transformative catalyst. The warrant structure is complex but ultimately aligns incentives. The fundamentals are intact. The macro backdrop is supportive. Volatility is the price investors pay for high potential returns. For those who can stomach the swings, Cipher Mining remains one of the most interesting hybrid plays in the market. Cipher Mining has just had a textbook rebound. The stock soared on anticipation, crashed on the headline, and now is bouncing as investors reconsider the long-term story. Google's stake is not a gimmick. It is a strategic partnership that could reshape the company's future. There are dilution and execution risks, but those are the risks that come with growth. If Cipher delivers, last week's drop will look like a blip on the chart. Friday's rally is a sign that the market may be starting to look past the sell-off and back at the bigger picture.